Hey traders, Jason here from Levitt Brothers. So let's talk about the current state of the market. All right, the market did well for the first 7 months of last year, then it corrected for 3 months, and then it went vertical the last 2 months of the year. The last 2 months were among the best as far as 2-month rallies in history. There was, somewhere in the top 10 or 15. So great. This year things have split apart. Okay, some stocks doing well, some stocks not doing so well. So good time. Circle the wagons and see what is going on the surface and beneath the surface. So I'm going to show the S&P weekly chart and the daily chart, and then I'm going to go look at a couple breath readings to kind of gauge what's going on beneath the surface. All right, let's get into it. All right, so here is the S&P 500 weekly chart that goes back to the beginning of 2020. So we got a huge rally, 2020, 21 off the COVID low. Then you could see market tops end of 21, beginning of 22, and we have this large kind of bull pattern. Now, you could look at this in a number of different ways. You could say this is like a 3-year consolidation pattern within a long uptrend that started not just at the beginning here over by the, in March of 2020, but like well before that. Okay, you can actually back the chart up, more than 10 years and say the market's been in a pretty good uptrend, a couple disruptions along the way. And right now we're in the midst of like a 3-year consolidation pattern within that framework. We can also look at it in terms of this being a pretty nice cup and handle pattern. There's your cup, there's your handle, a neckline over here at like 4,600. We broke out recently and we came back and we came up to the highs. We're not quite there, but we're pretty darn close. So that's another way to look at it. Okay, nice consolidation pattern lasted almost 2 years, broke out, moved last week, moved up 4 or 5 days, everything looking good. And then of course you can always just back it up a little bit more and just simply say this is one big cup pattern. Okay, however you look at it, we have a big, within the midst of a big bull market, we have a consolidation pattern that has lasted anywhere from 2 to 3 years, depending on how you look at it. Structurally, this looks really good. Okay, for the market to, even if you just look at this moving up, come down, test the 50, move up, higher high, but basically match the high over here. Even if we get a dip over here to the 21, which is, it's like 4,500, 4,530 or so, that'd be perfectly fine. Okay, nothing wrong with that. We can come down here and dip and then come back up here and consolidate and, try to break out after that. However you look at it right now, the structure of this entire chart is very positive. All right, let's zoom in a little bit with the daily chart. Here you go. Daily chart that goes back to last July. So it captures the entire August, September, October decline, and then it captures the November, December rally. And now we're sitting up, obviously, at near 52-week highs. Okay, so things look good, but there are some warnings in the near term. Let's point them out. Okay, so with the market over here, and when I say the market, this is the S&P 500. We got a higher high here, lower high here from the RSI, lower high here from the MACD histogram, lower high over here from the stochastic. So we got a slew of negative divergences as the market was pressing up to a new high at the end of the year. Then you can see the S&P corrected down to its 21, and then it rallied back to its high. During that rally, the indicators didn't come with. Okay, oops, it just disappeared. That's okay. The indicators did not come with. You can see the RSI has not gone back above, overbought. The MACD has not even crossed back over. And the stochastic is at a pretty good level, but it looks like it's crossing down here. So this is setting up a potential, another potential short. Okay, so we got divergences at the end of the year. Market corrected and recovered, but now we're getting more divergences because this is a higher high over here. This has not matched the high. MACD has not been able to match up the high. It hasn't even crossed back over. So this is a warning. Okay, in the near term, looking out next week, next 2 weeks, pressure, internal negative pressure is building. The price action is, on the surface, if you only look at the price chart, it looks decent. But beneath the surface, the indicators don't support a push higher here. So we got to, in this case, if you're long, you got to put stops really tight and anticipate the process, decent possibility that we're going to get a correction here. All right, let's look under the hood and get a glimpse of the internals. All right, so what we have here is the S&P 500, and we have the 10, 20, and 50-day moving averages of the NYSE AD lines, the advanced decline line. Okay, I like to look for divergences here. Okay, so you can see over here in October, the dips in October, we got lower low, but higher low from the 10-day moving average, higher low from the 20, higher low from the 50. So even though the market was falling, further over here, we got decliners beating advancers, but beating advancers by a lower amount. So the market was bad, but it was less bad. So you can tell that the turn was coming. The opposite is playing out right now. Okay, we got higher high over here. Even if it wasn't a higher high, even if it was just like the same higher, even if it was a little bit of a lower high, it's pretty obvious that 10-day moving average, the AD line, straight down, no attempt to move up. Even though the market, moved down and then moved up, no attempt to move up by the 10-day moving average of the NYSE 80 line. 20, same thing. So looking back an entire month, we just got this trending down. 50 looks to be in good shape. Okay, so longer term, looking back, 2.5 months, market is healthy. Okay, duh, because it includes all these data points. But when you zoom in a little bit, there's definitely the market is in less good shape than it was. Even though the market is right over here is at its highest level, decliners have beaten advancers over the last 2 weeks. All right, next one. So here is the S&P 500 up top, and down below is the 5-day moving average. It's all stocks high low. Okay, so we have a divergence here. It's higher high here, lower high here. Then we have a break of support here. Okay, so that breaks down, and then the market corrected and recovered, but you can see the 5-day high low hasn't recovered that much. It's above 200 or it's above 0, but not by much. So we have another divergence forming. There's a higher high there and a lower high here. Okay, so this is the 5-day high low. So with the market up here at a 52-week high, yet most stocks aren't even at like a 5-day high. Okay, so market dipped and recovered, and a lot of stocks dropped and didn't recover. Let's go to the next one. This is the same exact concept, except we're using the 1-month high low instead of the 5-day high low. Same thing is happening. Divergences at the end of December here told us that we were going to get some sort of dip to start the year, and that happened. Then we got a break of support here. No problem there. Market dipped and recovered. This dipped and has not recovered at all. So even though the market has recovered, printed a 52-week high here, we're not even getting 20-day highs. Okay, so beneath the surface, there's a lack of participation. The market is getting thinner. Next up, this is the S&P 500 up top. Down below is the Russell 3000 stocks above their 5-day moving average. Okay, so the first thing that happens, we got a warning shot back in December, where that broke support. Then we got a negative divergence formed. Okay, higher high here, higher high up there, lower high here. Market dipped and recovered. A lot of stocks lost their 5-day moving average, but not that many stocks regained it on the way up. Okay, so S&P 500 is going to be above all moving averages over here because it's at a high, and yet only less than 35% of Russell 3000 stocks are above their 5-day moving average. Okay, so lots of stocks. Let me delete that. When the market was at its high here, we had more than 80% of stocks above their 5-day moving average. Markets dipped and recovered, and now only 35% of stocks are above their 5-day moving average. So a lot of stocks have been left behind on last week's bounce. Last one, S&P 500 up top. Down below is the Russell 3000 stocks above their 20-day moving average. Okay, broke down here, no problem. It's not going to maintain a level for that long. But if the market was healthy, you'd get a dip and then a recovery. Okay, but we didn't. We got a dip, we got a big dip, and then no recovery. I mean, literally, like if you compare, market there, dips and recovers there. Here we have like almost a 90% print, and now this is like 31.55%. Okay, so market dips and recovers, and only 31.55% of stock, Russell 3000 stocks are above their 20-day moving average right now. So underneath the surface, the market's really thin. Okay, so on the surface, S&P looks good on the weekly time frame, daily time frame. Lots of divergences have formed, and on this recent bounce, it's not confirmed by the indicators. The MACD has not crossed back up. The RSI has not moved back up. And then you look beneath the surface, advanced decline line, high-low, stocks above various moving averages. All of them suggest the market got very thin last week. Okay, and we kind of know that because Microsoft, NVIDIA, Google, Amazon, several other tech names, AMD did really well, but it was a small group of really big tech companies that carried the weight, and everything else actually got left behind. So I'm operating under the belief right now that the market has gotten really thin, the internals don't support a move up, and we are going to get a correction. Hope you got something out of this. I'll see you next time.